Hello, today we'll be looking at 4.2 Macroeconomic Objectives of Government. We all know that most of our economies around the world are some degree of mixed economies, and government plays a major role in regulating and managing these economies, and government have certain macroeconomic objectives. Now, macroeconomics is an interesting part of economics. All this time you learned about microeconomics topics. In microeconomics, you learned about how individual players uh, behave in an economy. For example, how do producers behave when price increases? How do consumers react to changes in prices and things like price elasticity of demand? In macroeconomics, we look into the bigger stuff such as unemployment, total size of the economy, GDP, things like price inflation, interest rates, and what determines countries' exchange rate and this stuff. So, if you compare microeconomics to biology, microeconomics is going to be cell biology, and macroeconomics would be equivalent of study of the ecology, right? It's the bigger picture. Now, most economies have the following macroeconomic objectives. Firstly, to have low and stable price inflation to keep prices low. Secondly, to make sure that most people have jobs and unemployment levels are low and most people are employed, to achieve high economic growth, and to maintain stable balance of payments. In addition to that, governments can have other macroeconomic objectives such as to reduce inequality and to make sure there is sustainable development and the environment is taken care of and so on. But as of now, we'll be looking into these four major macroeconomic objectives and how governments can achieve them. Now, let's dig into the macroeconomic aims. The first macroeconomic aim that we're going to look into, low and stable price inflation. Now, inflation is sustained increase in the average price level. If inflation is increasing, that means prices are increasing at a faster rate, at an accelerated rate. And high inflation is usually a very bad thing. People do not like it, governments do not like it, because high inflation reduces purchasing power of people. It reduces people's ability to buy goods and services, especially those in the low income group. And due to increasing prices, they would find it difficult to sustain a decent standard of living. And as people's income fall, it causes a lot of hardship for those who are in the low income group. And also higher prices increases cost of businesses, because that also increases prices of raw materials that businesses need to buy. And usually during inflation, workers would demand higher wages, that further increases cost of businesses. And if we are looking at the external economy, import and export, usually during high inflation, goods and services produced in your country would become less competitive compared to goods and services produced abroad. So that reduces demand for export, simply because when goods and services that are produced in Malaysia are more expensive, foreign buyers would simply go and buy these goods and services from other countries where it is cheaper. And that can have a strain on countries' export. Businesses that are involved with exporting these goods and services, that can also impact, if those businesses who are exporting suffers loss, that can bring down their profits. That would also impact workers working for export-oriented industries, and that can also have a strain on countries' currency. Secondly, governments wants to make sure there is high and stable employment, because unemployment means there will be more people out of jobs, and when more people are out of jobs, it will cause hardship for people who lost their jobs and people who are dependent on them. People lose their livelihoods. They're unable to afford their basic needs. It causes a lot of people to fall under poverty. And also at the same time, it reduces demand for goods and services, because when people are out of job, they won't be able to buy things, and that reduces profits of businesses, and eventually businesses suffer loss and they have to close down, which is a really bad thing. And during unemployment, it in many countries they offer unemployment benefits, so government would have to pay more on welfare benefits to take care of those who have lost their jobs and their families. That means government have to spend a lot of money. On the other side, tax revenue for the government falls when there is high unemployment, because obviously when people are not earning, they are not paying any income tax, and at the same time, when people lose their jobs, they spend less money, so they will pay less in indirect taxes, for example things like on SST and GST, because simply they are not buying goods and services, or they're not spending money. If they don't spend money, they don't pay this indirect consumption taxes. And I think in recent time with the COVID-19 crisis, we're seeing unemployment is rising all across the world. Because of the lockdown, a lot of businesses lost their sales and they were unable to keep their employees, and they had to downsize, and a lot of people lost their jobs. And at the same time, those who are still having their jobs are not spending like before because of the uncertainty. And obviously there is obviously the fear of COVID-19. As a result, people are hanging out less, spending less on restaurants and shopping and so on. Unemployment can have also other consequences, such as things like crime rates can go up when people are out of job and desperate. So governments would always want to keep unemployment figures low, and the way governments can do it to make sure there are enough new jobs being created, that people have jobs. And as a result, many governments around the world are giving support to businesses to keep their employees hired. They're giving them wage subsidies. Governments are providing wage subsidies so businesses can continue to hire people instead of firing them. Because firing workers would obviously at personal level would cause hardship. It can increase poverty level, but it can have a downturn effect on the whole economy, which is something that no one wants. The next macroeconomic objective that we're looking into is economic growth in national output. Now, economic growth is usually measured using gross domestic product, or real GDP, which is basically total amount of goods and services that are produced over a year in an economy. So if there is economic growth, that means the economy is producing more goods and services compared to before. Now, economic growth is really good because due to economic growth, businesses experiencing higher revenue and profits, and they expand, they employ more people, and salaries and wages of workers go up, which means everyone have higher income and they can afford a better standard of living. Compared to 20 years back, Malaysian economy and most economies around the world have grown, and as a result, we enjoy a better standard of living compared to our grandparents. And so therefore, economic growth is very important to boost output, to increase income, to create new jobs and high-paying jobs, and to improve the living standard of people. At the same time, economic growth boosts investment by firms, because only when businesses are making higher profits, they will be expanding their business, investing into newer business, and that creates more jobs and creates opportunity for greater earning. And economic growth is also very good for government revenue, because when there is more output and more economic activity going on in the economy, the government receives more tax, because people are earning higher income, businesses are earning higher profits, they would pay more in taxes. And at the same time, during economic growth, due to high income, people will be spending more money, which means more indirect taxes. So government would have to spend less, and they earn higher revenue. And the last macroeconomic objective is to maintain a stable balance of international payment and trade. Now, balance of payment is a document that records all international transactions of a country. So that includes things like import and exports, investment coming into the country and getting out of the country. So all of this, and all economies today are open economies who are trading and doing transactions with the rest of the world. So what basically shows is that whether more money is coming into the country or getting out, whether more import is coming into the country or more exports are going out. So it shows it shows transactions with other countries. So if a country has a deficit on its balance of payment, it means that the country is probably importing more than it is exporting. And that can be bad because, if you are buying too much import, you have to pay using foreign currency and you'd run out of foreign currency reserve. You earn foreign currency when you are exporting. You have to make payments in foreign currency when you are importing. And it basically means that you are buying more than you are selling to the outside world. And that's a big issue that's going on in many developed countries. Countries like United States and China had been at trade war because USA is having continuous trade deficit. USA always continuously have been buying more goods and services from China than before. So that can be a problem. And before this COVID-19 crisis started, USA and China was already having a trade war, and because Trump was not happy with how the deficit was going on for many years. It's a complex topic, so we'll look into that later. The other problem with balance of payment deficit is that if you are importing way more than you are exporting, the value of your currency would fall. And if the value of ringgit falls, it makes it difficult for us to buy foreign goods. And therefore, that can be a problem. So governments want to make sure that the deficit is not that big, and so on. Deficit is not always bad, but we'll look into that. So these are the 4 major macroeconomic objectives most governments have.